Great to see you, Bob.
Thanks for
coming
having me.
in.
Appreciate it.
So we've been talking about right sizing, right?
Yeah.
And cost management and expense reduction. The Stripe example is a good one, as Dee pointed out, because they talk about sparser startup funding.
Yeah.
We think 2022 represents the beginning of a different economic climate.
Yeah.
You think that's true?
Yeah, I think it's interesting. Even just taking a look at yesterday and the reaction to the interest rates, right? So the whole FANG group traded off 4 or 5%. And obviously with tech, you have longer duration cash flows. So the more rates go up, the more the impact to your valuation. So you've seen that this year with the NASDAQ being down 30%, while 33%, while S&P is only down, low 20s, give or take. What I think is interesting, though, is each one of those FANGs or each one of these larger tech companies sort of also has their own thing they're addressing, right? Mm-hmm. So it's not just the broader picture that's taking place. So in Facebook's case, it's spending on virtual reality. In Google's case, it was YouTube being down for the first time ever on the advertising side of things. In cloud, Microsoft talked about PC sales. So you are seeing an impact across these large tech companies, maybe from recession you're in or just the general economy or anticipation of a recession or a broader pullback in the markets. But it's interesting how you're seeing all these large companies being impacted, but for very different reasons.
Right. In addition to the macro.
Exactly.
They got specific stories
Yes.
and universal stories.
Exactly right. Yeah.
On M&A, your general view is that next year is going to be better than this year, and that's not saying that much.
Yeah.
But that there will be a ready population to consider investing in M&A situations because Alpha's been so lean.
Yeah,
right?
It's really interesting. A lot's been going on in M&A. So first of all, we're coming off the record year, right? $6 trillion of global M&A. And this year we're down about a third, give or take, still making it the 4th or 5th best market in M&A of all time, right? So I think that's interesting. Very front-end loaded this year, right? You obviously had Broadcom, you had Microsoft and Activision, Twitter, all that stuff that happened in the beginning of the year. But a very decent year overall. What I think is interesting, though, is just the valuation parameters that boards and executive teams are thinking about, right? So one good example recently is Hellman & Friedman bought Zendex, right? Down 50% from its all-time high, $10 billion deal, so a very big deal, right? But you're still seeing a reassessment of what's a true valuation multiple now, and maybe not pinning or going back to the October, November timeframe last year where things are at all-time highs. So we're seeing our clients, our C-suites, our executive teams sit there and think about maybe we weren't worth 30 times revenues, maybe we're only 20 times revenues, or pick your numbers to fill in there. But we're seeing much more engagement now and much more of embracing the new reality and what that means.
Bob, it's Dee. I want to get your take on a conversation we had just at the start of the show. I'm not sure if you heard it, but we're talking about where we are sort of in cloud. Kramer brought up this idea that we may not be in the early innings anymore, at least when it comes from going from on-prem to cloud. Where do you think we are? What does that mean for the markets, especially some of these massive hyperscalers that drive so much action?
Yeah, on cloud, I still think there's a massive opportunity there. Having said that, near term here, as companies seek to reel in costs, right, and maybe push out further expenditures into later next year or when the economy is better, I think you could see some near-term pressure. And I think that's what we heard, quite honestly, from Microsoft, from Google, as they sort of tried to gauge what the near-term trends would be. But the economics there, the efficiency of it, all provides a long time for these companies to ultimately benefit from.
Okay, so who's better positioned in a potentially slower economic environment? Is it the hyperscalers that have consumption-based business models, or the REITs, the data center REITs that maybe have more fixed contracts?
Yeah, I think they'll both do well, but the hyperscalers is really where I think there's a lot of opportunity as they have that robust growth and as consumption. I mean, as usage and utilization increases, their models will benefit from that. And the one broader thing as you take a step back from tech is that overall, we can skip looking at this quarter or next quarter, but longer term, just the growth in tech and the growth of consumption, the growth in utilization and usage is going to be just tremendous for all these companies to benefit from, specifically the clients of these companies as well.